Okay, so thank you all for joining us this morning and allow me to present the smart data feed and how it solves some of the challenges of applying big data for investment decision making. Before we get into the subject matter, just want to give you some background about Lucena Research in case you don't know who we are. We are a leader in computational finance and machine learning. We connect leading data providers with buy-side investment professionals, and we help them extract actionable insights from curated and validated data. My name is Erez Katz. I'm a CEO of Lucena Research, and I'm really excited to present how we apply machine learning and data science for more accessible and actionable quantitative research. My goal today is to share with you where, in my opinion, the market is heading. Like many emerging technologies, applying machine learning to big data for financial decision-making is transforming through a revolutionary and evolutionary peaks and troughs. But there shouldn't be any doubt that data is here to stay and will continue to be an integral part of any investment decision. Therefore, identifying the most suitable data for a given investment objective is becoming more critical, and this webinar is mainly focused about solving this conundrum. Okay, here's a playbook for today. We're going to start, and we already started with an introduction to Lucena. Next, I will briefly go through the evolution of adoption of alternative data in finance and where we are in the cycle. We will then briefly discuss why alternative data has been slow to achieve wide adoption. Following that, we will present how Lucena's smart data feed is geared to overcome some of those obstacles and challenges. And we'll conclude with a quick demo and swiftly move into our Q&A session in which we are, again, you are welcome to ask any questions about machine learning, data science, and the alternative data space. Okay, so based on alternativedata.org, in 2018, there were about 375 different data providers with a median numbers of employees of 33 and 5 years experience. Now, I personally believe that the numbers are much greater, possibly in the thousands of data providers. But nevertheless, you can see and you can agree that the direction is a huge explosion of new data flooding the market. Data obviously comes in different shapes and forms, but if we consider alternative data, it is the portion by which we consume data that does not fall into the traditional fundamental technical and macroecon data. This is basically any data that comes in different format, whether it's structured or unstructured, whether it's satellite imagery or credit card transactions or companies that consume data, such as UPS for their own internal, business doing, but that data can be very effective in the context of financial markets and decision making. So lots of data that's available out there, and it's broken down to multiple categories. But the idea is to try and find which ones really are most suitable for a given investment decision. If you look at the Gartner hype cycle image, which is what you see on the screen here, any type of emerging technology go through these fluctuations of peaks and troughs. In my opinion, and again, where we are in the cycle can differ from one speaker to another. This is my personal opinion. We have surpassed the peak of inflated expectations. In the last few years, there was a lot of media coverage where a lot of notion of how machines are going to replace humans and how the human analyst is going to be an extinct kind of creature. Well, the reality is that that did not happen. As a matter of fact, many very large quantitative funds have closed and had narrowed down their way of doing business in the context of applying quantitative analysis for investment. And what we're seeing now, as we have gone through that evolution of peak of excitement and huge media coverage and hype, into the reality when it sets in, is now you have the next generation of data providers, data offerings that are based on that data provider context. And of course, the next generation of data consumers. These are the more sophisticated. They know what to expect, and they know how to apply data in a much wiser way than just letting a machine run free and roam free to make all the decisions. So obviously, the hybrid of machine and human is very critical here. But again, like I mentioned before, there's no doubt that data is going to continue to drive that movement forward on an ongoing basis, and it's the next generation now that's taking over into through the troughs of disillusionment into the slope of enlightenment, of course, a plateau of productivity, which is about to happen in the next few years. It's around the corner. This chart actually further underlines the notion of how we have reached a peak of quant funds and how they took a lot of the market share from the traditional investment, channels out there, and how in the last few months, the last year, we see a little drop in adoption, and many companies actually are moving back slightly, cautiously, into the traditional investment style. But still, the quantitative investment is still dominant, and we see that downtrend be a very temporary in nature, by which there's some realignment of expectations of technologies, of offerings, and it'll become prevalent and continue to take more market share in the future. So a survey that was just conducted earlier this year by Greenwich on alternative data asked several questions from data consumers. Is what's important to them in the context of buying and acquiring big data. And I want to repeat 4 of the questions that kind of resonated with us here at Lucena. The first one was tools for analyzing alternative data is as important as the data itself, and 71% actually answered yes. Next question was, is the alt data market flooded? And 63% responded as yes. The third question, is it difficult to find unique alternative data that's predictive? And 59% yes. And the last question was, do you prefer your data to be packaged in some easy to consume way versus getting it in raw format? And 62% answered yes. Now, from my experience, I can tell you that there are 2 types of consumers of data. There are the sophisticated hedge funds that have quantitative technology capabilities in-house. These folks want the raw data. They do not want the derived offering from the data or the signals. They actually would never actually rely on somebody else to tell them how to consume and how to monetize the raw data. But there's a very wide market out there that's growing in numbers of traditional fundamental shops that are going to the quantamental angle, as well as emerging new hedge funds that are looking for a more packaged, easily consumable data product. And this is kind of where it has driven our decision. This is the inspiration that took us from work we have been doing in the past to further enhance it into the smart data feed offering, which is essentially a bespoke delivery that is suited for a specific investment style and objective. So here's what we do here at Lucena. We take lots of data, we validate it. We don't take all data into our platform. We only take the best of breed after we've done the validation. So we don't have 2 data types for the same type of data, or 2 data providers for the same type of data. It's always, we find the best, most suitable data partner for a given objective or style. And we scrub the data, we map the data, and we validate the data before it gets to be on our platform. So we do all the heavy lifting for you, so you don't have to repeat the same process. And then we apply machine learning, a classification engine, to identify which multi-data source and multi-factor model would be most suitable. You see, what we do is when we save a data in our database, it is saved in a uniformly distributed format. So the data source is really not relevant to the machine. It sees all data is the same source. They're all equally evaluated by the engine. And essentially, it can choose a compilation of factors from 3 or 4 distinct data providers in one classification process. And that's the beauty of normalizing our data in a certain way that can live and coexist between multiple data sources. We then provide backtest simulation, model portfolios for perpetual trading simulation, KPI forecasting report. I'm going to show you an example of that in a second. And then all set to provide empirical validation of why we believe the data is predictive. Not only that, why we believe that the combination of factors from all these data sets together is most suitable for your constituents universe, for your investment style. And we package it in a way that is easy to consume through a daily data feed. I'm going to give you a demo of that in just a second. So this is the idea behind our smart data feed. It's supposed to, again, inspired by all these questions you see on the left side here, to allow consumers to take some of the heavy lifting of engaging with every data provider individually, consuming, scrubbing, mapping, and conditioning the data, and of course, creating the models to provide the intelligence out of that data. This is the second generation of data offerings that kind of came as a result of the shakeup that we see in the industry. So just about data validation, we discussed it before. I have a full webinar that we made historically on that process, but we have a very regimented process by which we ingest data and validate it. It's very important to do what we call best practice, by which you're not overfitting. You're creating a separate time frame for training and validation. You also have something called holdout, which is yet another unique data set by which you evaluate your models on new data sets. And of course, the green line that you see here is how we evaluate things into the future. I'm not going to go to the specific detail of what's happening here, but you can see that it's a pretty well-defined process that we do here. And we have all these reports that we generate through every step of the way to ensure that we're not creating false expectations from the data. And what's also important here that, when we train a model, it is a roll forward training process. It's not a fixed model. So we can change what factors are being used and how they're being used. As the market changes, our model changes as well, which is really important for, again, models that predict prices of forecasting. For KPI, it's a little different, but we'll talk about that in a second. When we talk about classification and machine learning, and I'm not going to repeat the detail of how machine learning works, but in essence, this is a good visual representation of how we take a concept that's been proven commercially, which is computer vision. How do you identify a picture and what's in the picture? And essentially, the machine identifies some of the features, that generalizing the features that are going to identify a bird through a convolutional neural network process. And I'm not going to get to the specifics, but essentially, you have this large number of samples that are labeled samples that shows, okay, this is a bird, and these are the features that represent a bird. So when you see something in the future that has never been shown to the machine before, you can see if those general features are available to determine what picture am I looking at. Now, the question is, can you apply the same principles to the stock market using alternative data with multiple data sets? And the idea is to create a very similar concept by which you have a picture. It's a multi-channel, multiple complex image with multiple data sets. Each one represents a time series. When you overlay them together at the same time, they present an opportunity historically for a buy and a sell signal. And that's how we can combine really, truly multiple orthogonal data sets or factors together so the machine can identify when these things happen all at the same time. Historically speaking, this is how the stock behaved, and that's how we identify the forecasting. This is really a high level, but just to get the concept of what the machine learning really does and how it applies multiple disparate data sets into one model. We do something beyond just the images of the time series called recurrent point. It's a little bit more, I guess, fancy way of describing the data in an image representation, but let's not worry about it here. Okay, so to summarize, here's what we do at Lucena. We take the entire life cycle from ingesting raw data, validating it, creating the reports of the validation, then scrubbing it, aggregating, mapping to symbology, and of course going to feature engineering, normalizing the data so it can coexist with other data sets in a very same database. We do extrapolation, interpolation, and of course at the end building machine learning models. And out of those models, we can create multiple derived offerings, backtest simulation, model portfolios to associate how these models behave on a roll forward future kind of basis, KPI forecasting report, and ultimately smart data feed reports. So this is kind of the process by which we take any data into our system. So to summarize, we do a lot of the heavy lifting for you. We get data that's ready, that's scrubbed, and you have an easy way of consuming it. And guess what? Only for what you need. So you don't get a bunch of data that you don't need. It's only for your constituents universe and for your investment style. This is an image from our platform, how you can subscribe for a daily feed or download historical data feeds. You can have an API consumption. You can have an S3 bucket drop. You can have FTP or email delivery. So it's really easy to consume in any shape or form you'd like. Last thing that I want to show you here is, before we go to the Q&A, is the format of what the data feed looks like. So you can see we've simplified of how you read the data in a CSV format per se. You can see that there are very few columns. Many of them are aggregated into a strength of a signal or conviction of a strength of a signal. And that's what we would give you as a result of our research. You can see every day you have the actual symbols that are mapped to our asset ID. We can survive, historically the symbols evolution. So we have dead symbols represented historically, and if they become something else in the future, we carry them forward. You can see that we rank a constituent universe. It's your universe from most suitable based on our analysis to least suitable. So it's one ranking factor you can use or ignore. You have the signal that we provide from 0 to 100 of how the regressor, our regression analysis, provide the signal in the context of this model. And of course, we have some conviction that we have at Lucena based on multiple factors, such as historically how accurate was the machine predicting these constituents, as well as the strength of the signal and the conviction of the model, altogether going to some sort of a conviction score by Lucena that you can use or ignore. Again, this is something that we give you as our best practice, but you can identify if it's meaningful for you or not. And of course, historical accuracy. How often, based on the last 63 days, how accurate was the system in predicting the outcome of these constituents. And the last thing is in sample, out of sample flag. And if there's any error or we don't have enough information historically, for example, on a given the new stock that just came in and we don't have enough historical information, we get an error code that tells you, hey, we cannot really rank this stock because it doesn't have enough historical data to build upon. That's pretty much the story. I want to give you a quick overview of what the outcome looks like. So this is what a KPI forecasting report looks like. So again, this is an example of Amazon gross sales that we generate from our system using multi-factor models for multiple data sets. Actually, this is based on a new data provider we just finished a big project with Equifax, consumer credit data. We're really excited about where this is going, but you can see here how we forecast KPIs for Amazon in this case. This is the historical, it's all out of sample. You can see the historical in orange of our forecast versus the actuals. And you can see the next quarter's forecast in green here, which we didn't have actual for at the time we generated the report. So we can always follow through perpetually how the forecasting translates to actuals in the future. Lastly, you can see here some of the detailed numbers. Again, the forecast versus actual, these are all in billions. But again, we have similar reports to other constituents using, again, the smart data that's derived from our data providers. One other thing I want to show you here is a quick example of what we do to create these bespoke data feeds. And I'm going to show you really quickly how it works without getting too much detail. So if I want to do a new scenario, I want to find a match. So I can upload, let's say, retail stock or healthcare stocks, put them into the system, and you can see all the constituents. I can actually compare it to a given benchmark. Am I a long only, short only, or long short signal? Very simple questions. Am I highly diversified or concentrated as far as my portfolio is concerned? What's my time horizon for rebalancing? What's the date range I'm trying to estimate? And of course, how do I want my data feed delivered? Email delivery or FTP delivery? And how frequently do I want the data feed delivered to me, whether it's daily, weekly, monthly, whatever that may be. And at the end of that process, a report that comes back from that process is coming. You can see 3 of our data partners, Cognobi Labs, very exciting partner for us, provides emotional AI based on communications. It's not really a sentiment per se, it's really how emotionally involved our consumers as they communicate through social media. Very, very cool company. Also, good partners of ours, Wall Street Horizon, provide corporate earnings information, as well as Insider Insights, which is a insider information, transaction information. And you can see the relevancy score doesn't mean that the data is good or bad. It's basically for this scenario that I just uploaded, what data has been most suitable. And you can see here the conviction level using an event study graph that shows if I use those 3 signals together, here is my average outperformance against the benchmark that I would expect into the future. Just a quick kind of overview, as well as a backtest that shows you over time those signals without doing too much fancy, investment style, how the signals translate to outperformance against the benchmark. Again, we're not telling you how to trade. We're not telling you this is how you should allocate your portfolio, how to trade. This just is meant to show you empirically why we believe those 3 signals are most suitable for the specific universe of constituents that you are most interested in. Anyway, that's all I have for you today. Let's move on to the next phase of this presentation. Catherine, what's next?
Do you have futures in your assets?
Okay, yeah. So we have futures. We have actually commodity futures. We've done some research, mainly in the natural gas, oil, silver, and gold. So these are the 4 main categories we have done some research on, with some interesting results. So, and by the way, these are very suitable constituents for alternative data, as you can imagine. So the answer is yes.
Great. In regards to KPI predictions for the most recent quarter, how did your predictions compare to those of analysts? How many equities did you predict on?
Yeah, it's a fair question. So analysts, surprisingly, are doing a fairly good job in forecasting KPIs. In many cases, they are very close to what we forecast. In some cases, they're actually doing a better job than what we forecast. What we did find was when analysts actually miss the forecasting is where we actually become much more relevant. When everybody agrees on where it's going and it's common knowledge, we are sort of in line or maybe slightly below analyst recommendation. But when they are missing, we have the ability to have the foresight into a more accurate forecasting. So it is a fair question. We do compare our analysis to the analyst's analysis frequently as well.
Great. So we got a couple more. Do you evaluate based on GainDrawdown Ratio over time?
Yeah, so total return, which I think what you meant by gain or drawdown, is one of the elements that we identify. For KPI, we have very clear metrics by which we identify the accuracy of the forecast. We use something called R-square. We use SMAPE. We have other types of statistical measures to see how, over time, we get close to what the trend line of the true ground truth is. In the context of forecasting prices of assets. We look at Sharpe ratio, we look at R square, information ratio, drawdown, volatility, you name it. We have all the attributions fully covered in our backtesting, and I'm happy to share with you offline what the backtest looks like. But it's a very comprehensive attribution analysis as well as a performance analysis of the simulated portfolio, as well as transaction costs and slippage, all fully factored into the analysis.
In the subscription to the platform, do customers have access to the historical scores on each asset? And if yes, how many years back?
Okay, so it depends on the data. So the answer is yes. We don't give you access to the raw data. So it's all derived signals or feature engineered signals that come from us, right? So the idea is to allow the data providers, our partners, to continue to sell their data uninhibitedly, and we don't want to cannibalize, their core business. What we are offering is essentially a derived offering that protects their intellectual property and provides some sort of a signal above that for a different audience, and that's what you would get historically. And we share with you everything, including the historical decisions that the machine made based on which signals, as much as we can. Now, how far back, it depends on the data. Some data is only going back a few years. Social media, for example, was not available 10 years ago. And we have to kind of conform to what's available historically by the data sets. And that problem, by the way, is exacerbated with the KPI forecasting, because KPI is a quarterly kind of notional data. So if you have 20 years worth of data, it's 20 times 4, it's 80 data points. It's not a lot of data to train a machine on. So the alternative data that has a shorter time span of only a few years is very difficult to use in the context of KPI forecasting.
Great. So we got, how do you price the smart data feed product?
Okay, it depends on the data that we associate. It's a low price point, then you have to buy each data set individually. We like to make it very affordable, anywhere from $3,000 a month to $5,000 a month in most cases. So I don't know if it's actually cheap or not cheap, if it's affordable or not affordable for in your eyes, but buying raw data in general is much more expensive. And by the way, you may ask yourself, why would a data provider, want to partner with us and sell the data in a much cheaper price point than they would do themselves? And the reason is very simple. Number one, we allow others to realize how great their data is, because really, if they are on a platform, we have all the empirical evidence of how good the data is. But also, the data is provided to a new audience that they would never sell to begin with, because getting that raw data from a data provider and trying to analyze that data internally is an expensive and complicated, and you need to have a lot of domain expertise to do that. In a way, we are democratizing that accessibility to the data to a brand new channel of distribution they wouldn't have had otherwise.
Great. So how far out do you forecast KPIs? 1 quarter, 1 year? How does your accuracy of your forecasted KPIs change as you increase the forecast horizon?
Yeah, so we really are trying to forecast 1 quarter at a time. We do have, it's actually interesting point. One of the things about KPI, I mentioned before, it's like it's a quarterly data point. So it's very sparse data that you have to work with. Now, some of our data that we try to superimpose or involve in that KPI forecasting is daily data. So how do you kind of match or map quarterly data with daily data or monthly data, depending on what data you're trying to kind of use in the context of the multi-factor model? One of the ways we do that is we use multiple time horizon forecasting based on seasonality alone. And it's interesting to note that most of the forecasting capabilities of KPIs are seasonal in nature. The notional value add of the machine learning is actually small in comparison to the attributions coming from seasonality and the trend analysis. So we can start to, again, extrapolate data into the future using ARIMA or using Holtz-Winter. These are two methods that I wrote about in one of my blogs to create that in between data points between quarters. And that's how we do. But again, to get the KPI forecasted, Taylor, maybe I'm wrong here, but it's a 1 quarter at a time. Is that correct?
Yeah, for the most part. A lot of the data sets that we find are most predictive of KPIs are more focused on things that are happening during that quarter. So they're really only relevant for that quarter's earnings report. There's nothing machine learning wise that's limiting us to that quarter though. It's more of just what our inputs are and what they're intuitively capable of. You know, if I'm looking at, for example, if I'm looking at transactional data on credit cards, it doesn't really help me for predicting, you know, a year out. It's mostly what's happening between January and March for Q1, right? So to sum that up, we're not limited in predicting based on the machine learning side and the modeling. It's more of a limitation of what your input data describes.
Well, this is Taylor Korf, our VP of R&D, in case you're wondering who this person is. So glad to have him on the panel with us here.
So for fundamental discretionary managers, which part of the research process have you seen alternative data and machine learning be most impactful?
So what data is most impactful? That's a loaded question because it depends. And actually, surprisingly, you'll be surprised that sometimes the simplest, the most intuitive data sets are most predictive, and the most sophisticated or glorified novelty-based data may be very nice, but not as predictive from that perspective. So I'll give you an example. Wall Street Horizon, a great partner of ours. You know, they have the most accurate, most clean data for corporate events. But we identified that when you push an earnings date outwards, in other words, you postpone your earnings date from the previous announcement, or you change your earning dates to be earlier than previously announced, that's informative as to the output and the outlook of that company's results. Interestingly enough, when you combine that data, and that's informative enough, and there were some white papers written about it, we didn't make that up, but once you combine that data, that information with additional factors that we have from other data sets, then really magic occurs. We actually have been following a model portfolio with a long only and a short only, and they're doing tremendously well. And we are really excited about, you know, simple data that became, because of the nature of how clean and how accurate it is, became very relevant and very actionable for us. So it depends on the data set, depending on the situation, but you'll never know until you test it. There's no preconceived notion of novelty as an indication of predictability or forecasting ability.
Great. How can one trust a backtest? How can bias or overfitting be removed in backtests?
Yeah, so Taylor, you could probably chime in, feel free to chime in, but backtest cannot be trusted fully. I mean, you have to trust the people who run the backtest for you, because you can make any backtest look great. Every time I show a backtest to some of the quant funds, I see people start looking at their watches, at their phone, rolling their eyes, because you can always make a backtest look great. I've showed you several slides before that are meant to show how we minimize overfitting, how we create a real process by which we can trust our backtesting. But in true, the only way to trust as an outside, unaffiliated buyer is to look at the perpetual simulation and follow through that, I guess, time horizon of trial. In real time, so we get the signals before the market opens, and you can see how they translate to information for you before you make these final decisions. Anything you want to add?
Yeah, I think one of the more powerful things about this platform is it allows you to evaluate data in essentially a third-party sandbox where you can't be lied to in a way. We have no reason to lie, right? and you don't really have, you're once removed from the data provider, and we're keeping track of a point in time representation of their data. So when you run a backtest, and it doesn't require twisting a bunch of knobs and adjusting a bunch of settings. For the most part, it's a couple of clicks and it goes. But when you run a backtest, that's happening independent of the data provider. It's something you kicked off. It's calculations that are happening for your process. It's private, obviously. And the platform prevents you from making a lot of the easy to make mistakes when backtesting, when making a model. It's not going to allow you to do survivor bias stuff. It's not going to allow you to do look-ahead bias and a bunch of other stuff. It's not going to allow you to do. It's going to handle all the heavy lifting for you. So as far as how do you trust the backtest, either you trust the person running it, or you have some sort of sandbox that where you're the one kicking it off.
So we have about 5 minutes left. We'll do one more question. So if you have anything else you want to ask, please feel free to submit and we can follow up with you directly after. Or if we have time, we'll do one more. But the one additional question that we're going to do now is, what's the best way for someone who isn't using alternative data or a purely fundamental shop to ease their way into quantitative analysis or incorporating alternative data?
Yeah, that's a good question, and we see it quite a bit. So a lot of fundamental shops are realizing there's a revolution going on, and they need to change their ways, not take away what they built over the course of 20 years of experience, still maintain that expertise in-house, but start to maybe dip the toe in the water in the context of adding other data sets into the decision process. What we found to be very effective, again, this is what our platform kind of supports, is the ability to run a side-by-side simulation of what your natural portfolio would do and how that same portfolio compare apples to apples with a machine learning data intelligence value-add extension. So that's kind of one way to do that, is not to change your way, but to add one more column in your spreadsheet per se that has one more factor to consider and see how impactful that is on your portfolio. Even if you have a 15 bips incremental value add on multi-billion-dollar fund, it is somewhat significant. And once you see that in trial over a period of 3-6 months, then you pull the trigger and you start to drive some real cash around it. I see, by the way, a question about the number of factors that are being used in our neural network, and how we apply the deep neural nets to create the classification. And that's a great question because the technology of deep neural network is rather sophisticated, and it has two challenges. Number one, it's very hard to explain which specific factor was responsible for a given decision, because you have multiple factors and they're all broken down to multiple vectors of information in the engine. So you can possibly have 1,000 parameters that could be responsible for the formula that describes either a regression or a classification problem. These are very intricate, nonlinear relationship between multiple variables that the machine is trying to identify. We found out there are two challenges. It's powerful technology. It's revolutionary. It's transformational. No question about it. But we found out that if you put too many variables, you are subject to overfitting. Back to the question before. Very important to note that. The other thing that's really important to note is that you have to have an abundance of data to train the machine, abundance of label data. Label data meaning you know what the output was historically to train the machine of a state and an output. State and an output, so you can start to generalize these things. We've done some extensive research on using both recurrent neural network, RNN with LSTM, and convolutional neural networks. And actually, we will do additional webinars because we have had some interesting breakthroughs on these type of research that we are very excited about. But that's beyond the scope of this webinar. Yeah, we have a lot of other questions here, and we are going to try and respond to all of these questions individually and publish the Q&A to everyone who participated. I really want to thank everyone for coming in today and giving us a chance to really demonstrate our capabilities.
One more we do want to ask or answer really quickly is, can the platform combine internal data, like an internal analyst forecast, with external data?
Yes, so happy to take it offline as well, but the answer is yes. That the beauty of it is if you have unique data that you want to see how it works with other data sets, that's the beauty of our classification engine, because once we put you on our platform, even though you are in your own sandbox, we expose the other data sets that are available to combine with yours, and then you can see how valuable the value add of your data by itself, as well as once you add multiple factors from other data sets together to create the best of breed. There's a lot of questions coming here last minute. I promise we will get to all of those. I wish we had more time, but thank you so much for joining us today. Thank you, Taylor. Thank you, Catherine, for making this day possible, and we'll talk to you guys soon. Have a good day.